Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to review a piece from the Wall Street Journal from the Federal Reserve's mouthpiece, Nick T. So if you guys want to know what the Federal Reserve is going to do at their next meeting, one of the ways you could do that is by following Nick T with the Wall Street Journal, because for some reason this guy gets all of the inside information, it appears, from the Federal Reserve before anyone else does. Now that's probably happening so he can prepare the market. And today we're going to go in why it's the end of the era of the low interest rates. Thank goodness, because the reality is, you guys, the zero interest rate policies that we had was a complete failure. And the reason why we're in this situation to begin with is prolonged low interest rates. Interest rates were really low well after COVID. And not to mention, you guys, school loans haven't even started yet. So the thing is with interest rates currently skyrocketing, and you guys see that more than likely, I believe we will hit 8% this year. Rates in the 7 and 8% is really going to put a lot more additional pressure on home prices to come crashing down. And the beautiful thing about all of this, you guys, is this is starting in August. So not only will we have all of these pressures and no longer will we have low interest rates, we're also going to have additional pressure on prices to go down from normal seasonal factors. So odds are, you guys, going into the end of this year is that's when we'll start finding great opportunities to buy again. Now, I suspect the opportunities to buy will be greater in 2024 and in 2025. So it's especially important that you understand what you're looking for in the housing market. So make your goals and understand how to find it. But regardless, you guys understand I'm not a financial advisor, even though my bio is as someone that wants to buy a house. I'm frustrated renting. I'm getting up early in the morning so I can get these videos out and then go to my W-2 corporate job. So I'm just working really hard right now to get ahead in the future. And I want to take you guys with me through that journey. I still am looking for my own primary residence. It's driving me crazy. So if you guys can, again, like this video, subscribe if you haven't already, shoot me a comment below. But either way, you guys, I really hope you enjoy this video from the Wall Street Journal. It will be linked in my description, but unfortunately, y'all, you have to have a subscription to access it. Now, the name of this article is why the era of historically low interest rates could be over. And that's exactly what we want. We do not want these low interest rates. From Nick T. So this is something that we can pretty much bank on is happening and is in the mind of the Federal Reserve. Despite the Federal Reserve raising interest rates to a 22-year high, the economy remains surprisingly resilient, with estimates putting third quarter growth on pace to easily exceed its 2% trend. It is one of the factors leading some economists to question whether rates will even return to lower levels that prevailed before 2020, even if inflation returns to the Fed's 2% target over the next few years. At issue is what is known as the neutral rate of interest. It is the rate at which the demand and supply of savings is in equilibrium, leading to stable economic growth and inflation. And obviously, you guys, we did not get stable growth as a result of COVID, 2% interest rates, billions of dollars in stimulus put into the hands of the consumer. I mean, there is nothing about the equity buildup that was natural, normal, or even sustainable. And let's look at just how high they had to increase interest rates and how quickly. According to Fed economic data, we're sitting at an average interest rate of 7.09%. And I can tell you guys, if you have any challenges whatsoever, you're going to have a higher interest rate right now if you lock over 7.09%. But what I want to point out is the last time that interest rates were this high, you guys, was all the way April of 2002. Interest rates are higher right now than the last great financial collapse. But one of the reasons why this has been so devastating, despite them saying the economy is so resilient. And the reason I'm saying this is because I don't believe the economy is resilient. I believe it appears that way because of the bank bailout that happened in March of 2023, when the Federal Reserve essentially injected initially $400 billion into the economy, which they had to do because of this massive run-up in interest rates. Essentially, interest rates went from the low threes all the way up to 7% in less than 1 year. And the market, y'all, does not have time to adjust to that massive skyrocketing in interest. We can see that here when we look at the 4 bank failures that happened this year, of which number 2, 3, and 4 biggest bank failures in all-time history happened this year. Again, as a result of the skyrocketing interest rates. Now, obviously, you guys remember it started with Silicon Valley Bank, and then it went to Signature Bank. Next was First Republic Bank, followed by Tri-State Bank. So there have been a minimum of 4 banks right now that have went belly up. We're going to go back into the neutral rate. Neutral can't be directly observed. Instead, economists and policymakers infer it from the behavior of the economy. If borrowing and spending are strong and inflation pressure rising, neutral must be above the current interest rate. It does appear that we have another round of inflation, which would mean that the neutral rate needs to be higher, essentially. If they are weak and inflation is receding, neutral rate must be lower. The debate over where neutral sits hasn't been important until now. Since early 2022, soaring inflation sent the Federal Reserve racing to get interest rates well above average. That is absolutely strangling the market. Another place that it's strangling the market is with investors. You guys, interest rates skyrocketing like this absolutely destroyed the cap or profit rate from these investors. Essentially, say they're getting a return of 5% a year. The thing is I can instead put my money in treasuries and get a return of even more than 5% per year. And I don't even have to do anything, and it's risk free. And y'all, look at some of the rate of returns on this stuff. It's crazy. The 1 month right now, as of this video, is sitting at 5.38%. The 2 month, 5.4. This is insane. 6 month is at 5.5 right now, with the 10-year sitting at 4.3. So these are all treasuries people can purchase. And basically when it matures, that's when you get your profit. So what I use, you guys, is Treasury Direct. So I actually do have treasuries. I do 1 month treasuries, so my liquidity is not wrapped up. To be honest with you guys, I should probably just do 6 month treasuries because it's yielding more. But if you're interested, what I did is just literally go on YouTube, look up a video, how to purchase treasuries. I'm using Treasury Direct, and I find that it's a great way for me to combat inflation because I get $200 to $300 back per month for just putting my money there. I like that. With inflation now falling, but activity still firm, estimates of the neutral rate could take on greater importance in the coming months. If neutral has gone up, that could call for higher short-term interest rates or delay interest rate cuts as inflation falls. It's important to understand that this is the Federal Reserve's mouthpiece. So more than likely, like Jerome Powell said right before the bank failures in Congress, higher for longer. It could also keep long-term bond yields, which determine rates on mortgages and corporate debt, higher for longer. And that's good because we need a curve demand. Every quarter, Fed officials project where rates will settle over the longer run, which will affect their estimate of neutral. The median estimate declined from 4.25% in 2012 to 2.5% in 2019. After subtracting inflation of 2%, that yielded a real neutral rate, sometimes called R or R star, of 0.5% in June. The median was still 0.5%. This also happens to track a widely followed model co-developed by New York Fed President John Williams that also puts neutral at 0.5%. This goes on. But while the median hasn't changed, some officials' estimates have been creeping up. In June, 7 of the 17 officials' estimates were above 0.5%, and only 3 were lower. A year earlier, 8 were below 0.5 and 2 were above. So you guys can see that has flipped. And basically what this means is there's still inflation in the market. And we can see the inflation in the housing market, especially if they're saying that new records were broken. If new records were broken, that basically means in some metro areas, the rate of inflation was actually worse this year than last year, which is shocking to me because Quantitative tightening. Things are way more unaffordable. I have no idea how there were so many buyers to continue to prop up the prices. Just so shocking to me. Let's continue, guys. Why the neutral rate might be rising. Analysts see three broad reasons neutral might be higher than before 2020. First is economic growth is now running well above Fed estimates of its long-term potential rate of around 2%, suggesting interest rates at their current level of 5.25 to 5.5 simply aren't very restrictive. And we see it clear as day in the housing market. And we saw that this year because, again, people kept buying. So the rates were not high enough for the housing market. Conceptually, if the economy is running above potential at 5.25% interest rates, then that suggests to me that the neutral rate might be higher than we've thought, said Fed President Tom Barkin. He said it is too soon to come to any firm conclusion because obviously the economy is more than just the housing market, although predominantly that's really all I care about. That said, a model devised by Richmond Fed, which before the pandemic closely tracked Williams' model, put the real neutral rate at 2% in the first quarter. Now, the second reason, swelling government deficits and investing in clean energy, that is definitely adding to inflation, could increase the demand for savings, pushing neutral higher. Estimates that real neutral rate has risen to 1.5% because of higher public debt. Former Treasury Secretary Lawrence Summers agreed 10 years ago that slow production growth, inequality, and a shortage of investment opportunities would create a glut of savings and depressed neutral. But he has recently suggested neutral has gone up because of high deficits and the investment to transition to a slow carbon economy. So basically, there's still a whole bunch of stimulus in the economy at work. Third, retirees in industrial economies who had been saving for retirement might now be spending those savings. Productivity boosting investment opportunities such as artificial intelligence could push up the neutral rate as well. Similar debates are underway in other countries. Interest rates are more likely to settle at a level above, not below the pandemic norm, which is really, really, really good, you guys. So again, more than likely, interest rates are going to settle at 5%, which is exactly what we want, if not higher. We'll read the last part of this article now. Key Fed officials are less convinced. The debate remains far from settled. In April, the International Monetary Fund predicted that U.S. real neutral rate would stay below 1% in the coming decades because of aging populations and tepid productivity growth. Williams said at a recent Fed conference he wouldn't rule out surprises that rise neutral, which again would lead to additional inflation. But he expects an aging global workforce that boosts the supply of savings and technological change that reduces the capital intensity of production would eventually push it to or even below its pre-pandemic level. Fed Chair Jerome Powell has in the past warned against setting policy based on unobservable estimates such as neutral when compared to navigating by celestial stars. In conclusion, when I read that, again, this is from Nick T, the Federal Reserve's mouthpiece per se. He really kind of gives the market a warning on what to expect to happen next. So what I'm reading, you guys, is essentially they don't know. The Federal Reserve doesn't know what to do, but there are more people on the board that are leaning towards higher for longer than not. More than likely, we will see average interest rates this year of 8%. And I'll also say, you guys, we actually need that. And when they do start decreasing interest rates, in my opinion, we need to keep interest rates near 5%, hopefully in the mid 5%. And that because that's one of the way to make sure that the housing market stays balanced. And I hope you guys understand that. Other than that, I hope you guys have a wonderful evening, and I hope you guys got some new insights, value, and perspective. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.